Peter Rose, Longwood Currency Trading. So exactly how do you beat the big boys? How do you compete with them? In my last video I said, well, you can't compete with them. So what can you do to win? Stay tuned. Let's talk. So I couldn't pass up the day. It's such a beautiful day. It'll actually be probably getting into the high 80s. We've been a little bit in the high 80s, but I had to come out and be outside. The guys are going to come and mow the yard here pretty soon, so I'm not going to be out here then, because I would think that I'd have to help, and I don't want to do that today. How do you compete with the big boys? In the last video, as I mentioned, you just can't. So how do you trade? I mean, if you can't compete with the big boys, what are you supposed to do? Well, you're supposed to trade for what you're capable of doing as a retail investor. Remember, you're not accumulating currency product for customers, for clients, so that they can use that currency to buy engine parts or whatever it is that they're going to do. You are accumulating a currency or selling currency in order to provide opportunity for yourself to make money. And in the big picture of things, you're providing liquidity for those big guys and for each other. You know, one of you is long and one of you is short. So they say that it's a zero-sum game. One person wins and one person loses. Let's say the currency pair is going up and you're long. So you sell it and take your profit. So you'd say, well, the guy that bought it from you must have lost, because you've taken the profit and won, so he's lost. But he may be thinking that the price is got more room to move, and he's willing to take that risk that it's going to go up. Or maybe it's an institution that's riding the price up higher, and he's going to use that liquidity in order to increase his position size. So we all work together in this thing. It's not that the retail traders are just scumbags picking off the dead bones of what's left. It's that we're providing an economic function to that market. They didn't need us 30 years ago. You couldn't trade as a retail trader. And they don't need us now. A $6.6 trillion market, and we're 15% of that from a dollar value. That 15% is a shithouse full of money, but it still pales in comparison to the other 85%. So if the whole retail market shut down, it's not going to impact what the larger banks and institutional funds are doing. They're still going to continue on. So what function can we possibly bring to bear? What system, what methodology, what thought process can we possibly bring to bear within the scope of this market, and the fact that we're just the tail here being wagged by the dog? How do we trade? How do we make money? And I've been harping on this. This is my 7th video, 106th video or something like that. And it's based on, instead of trying to grab 50 pips, because the banks are running these campaigns that go 50 pips, 100 pips, 200 pips. The pin bars are caused by them for the most part. And so to try to set our profit targets at the same point that the banks do, as a lot of the bank traders who are coming into the markets and trying to teach us retail traders how to trade like the banks, that's just stupid. We have to play our own game. Jesse Livermore said that. I play a lone hand. I don't pay any attention to the news. I don't pay any attention to what anybody has to say. I look at what the tape is doing, and I trade according to that. I make up my own decisions based on what's happening. So if you're basing your decisions on macroeconomic news releases and head and shoulders patterns, you're fucked, because you're in a competition with those larger institutional traders. So that's why we say, those of us who purport this stuff, throw all that stuff out. Throw all that kind of study out. It's not that you don't have any study to do. You do have study to do. That study has to do with yourself and your discipline to get out quickly when the trade goes against you, and to ride the profits as high up as you can, but be sure that you lock in 5 or 10 pips, because you're playing a short hand. You're not trying to play the 50 pip run, because if you play the 50 pip run, you got to take a 50 pip risk to give the trade room to breathe. And it just, you look at any price chart and you see it goes up and it comes down, and it goes up and it comes down. If you're on a daily chart, it goes up and it comes down. You know, pound dollar, 100 pip a day ATR. So it'll go up 100 pips. Now it doesn't go up from the close to 100 pips. It can move 300 pips in a couple of days, 3 days, but it chatters. So that price action is going to move through a range of 100 pips, but it could move 10 pips up and 90 pips down, and then move back up and show a 4 pip profit or a 4 pip gain for the day. Do you want to stand there under a 50 pip swing or a 60 pip swing to make your 5 pips or 10 pips? No. Play the short game. Don't try to compete with what the big guys are doing. Play your own game, because that's the only way you've got a chance of profit, quite frankly. I've said that recently I've become sort of quite antagonistic against the longer term educational resources that are out there that are teaching long-term stuff, and their insistence that the way to trade retail is to trade alongside of the large institutions. And my position, and a lot of price action traders' position, is no, you don't want to trade alongside of the institutional positions. You figure out where they're trying to push the market to satisfy their client orders, but you've got, you've got $6 trillion of money sloshing around, going in all kinds of different directions. So you have to really have a set of rules that looks at what conditions it is that you're trying to trade for. If you're trying to be in the market for, like I am, for a couple hours, do I need to really concern myself with what's happened on the weekly chart? No. Do I need to concern myself with what happened on the daily chart? No, not really. I mean, I might set some parameter guidelines. If I'm going to be in a trade for a couple hours, then I might want to know what, I mean, just because the market's open 24 hours doesn't mean that it's actively moving at 100 pip ATR for the day. Because if you look at the chart, by the time you get down to when everybody's gone to lunch or gone home or whatever it is, you still have active trading going on, but the ATR at that point might be, and it's not an ATR, but the average range over the period when the market is sleeping, might be down to 20 pips or 30 pips. I look a lot on the 15-minute chart, and that's up all the time. And when you go after, 1 o'clock Eastern U.S. time, or 2 o'clock Eastern U.S. time, 3 o'clock, 4 o'clock Eastern U.S. time, that 15-minute ATR, which is usually, 7 to maybe 10 pips or something like that, is down to 3 or 4, 5 pips. So you have to take that into consideration of what you're doing. You can't look macroscopically at a market that goes microscopic on you. If you're basing your trading scheme Oh, let's say you've done what I've done. You've run computer simulations over blah, 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 and you get certain really good statistics. That's really true. But when you're really trading, you're only trading whatever the prime market hours of that currency pair, or the hours when you're actually awake, unless you're crazy like I am and you get up at 3:30 in the morning or 2:30 in the morning to see what's going on in Britain, or at 8 o'clock at night I'm trying to figure out what's happening in Sydney. It's the microcosmic view of this market that you have to take. And as soon as you take that microscopic view, you can throw out a whole bunch of problems for yourself. You still have the major premise of those problems, which is risk management, position management, selecting your entry point, staging, whatever processes it is that you use in your methodology is fine. But in the long run, what we're saying is that you're looking, if you're going to be a day trader, you're not looking at the chart when you get up in the morning and then after you come home at night. That's not day trading. You have to, if you're going to do that, you're going to have to let that trade run for a couple of weeks, because that's the only way you're going to get the average price, the only way that the ATR is going to work in your favor. So, okay, so if you're working on the daily chart and the ATR is 100 pips, you got to be cognizant of that. If I'm going to only be able to trade from say 6 in the morning until 8 o'clock when I have to head off to work, or 5 o'clock in the morning to 7 o'clock when I have to head off to work, you have a 2-hour time frame. Wherever you live, pick the currency pairs that are really active during those time periods, and you don't want to be in the trade more than a couple hours, so you're in and out. Guess what time frame you're going to be looking at? Are you going to be looking at the 4-hour chart? No, I don't think so. You might have, if you trade by support resistance boundary zones, then you may be looking at the 4-hour to see where you're at in relationship to some major plug point that the institutions are working off of. But for all practical purposes, you're down trading the 5-minute time frame. You could get away with trading the 1 minute. I don't trade the 1 minute for trade entry. I may trade it for risk management, but I'll trade the 15 and 5 minute if I want to just trade for a couple hours and then get on with my day. Because I'm only looking to make 5, 8, 10 pips for the day. If I make 10 pips on a one lot, I made $100 for the day. But since I'm looking to trade more than a one lot, I trade 3 full lots, I make $300 for the day. Some folks don't make $300 a day. Some folks don't make $300 a week. So let's not be greedy about this thing and say, I'm going to take my one lot and I'm going to trade for 50 pips because I want to make $500 on that for the day. You're not going to do that in a day unless you get absolute cherry conditions. But if you're a day trader, you want to trade. When are those types of cherry conditions going to occur? They might occur 2 or 3 times during the course of a 4-hour period of time. Maybe once during a 4-hour period of time where you get that cherry-picked time. You may not see that, and you're going to want to trade. So now you're going to force trades to match this grandiose desire of you to make 20 pips a day. You can't do that. You can't mix the micro view and the macro view. You just can't do that, and that's what all of you are doing. Why do I say all of you? Because I know that's what you're doing, because that's what you're trained to do. Watch all the YouTube videos out there that you want and see if I'm not right in what I'm saying. You might run into a few people that are realistic about this stuff and trading in the correct manner. Langers, the scruffy trader from the UK. Check his channel out, because he's been doing this 20 years. And it's simple to him. It's simple. And he's got a methodology and he sits there. But he trades all day. What happens if you're not in that situation? where you got to trade for a couple hours. Well, you could take the types of methodologies that I propose, that he proposes, and other folks that are doing successful day trading, and look at them and figure out what's going to match what your needs are, and then how you build rules around that. So can you compete with the big guys? No, you can't. You can't compete with them. Don't even try. Don't even think about it. So you need to get educated. You need to find a resource that's going to show you how to lay out a trading plan that makes sense if you only have a couple hours a day to trade. Now, let's say that you've got 8 or 10 hours a day to trade. Well, that's 5 2-hour periods. So that means that you could work your trading through that 10 hours, but maybe not on the same currency pair. Maybe you'd want to have another currency pair that dovetails about halfway through that period, so you trade one currency pair to that point, and then you jump to another time frame and trade the other currency pair on the other time frame. I'm not a huge proponent of trading multiple currency pairs because I think it's distracting, and you're trying to trade on one and you're looking at the conditions on the other one. I just don't think you should be doing that unless you've got 5 or 10 years. I'm sorry, 2 to 5 years of experience. I think you'd probably need that so that you wouldn't get distracted in doing it. Those are just arbitrary things. I mean, I've been trading for a long time, and most of it is not successfully. So, you know, I'm not ever going to probably trade more than one currency pair because I only want to trade for a couple hours a day, and then I want to go. I'm retired, for Christ's sake. I don't want to sit at the computer terminal and trade or sit on my cell phone. I never trade on my cell phone. That just is idiocy beyond comprehension. But regardless of that, I think I'm like most folks. You'd like to be able to trade and make sufficient money during that short period of time so that you don't have to work for a living. You can trade a couple hours a day and make 10 pips. I think that's a relatively good standard to strive for. Now, some of them you'll make 20, and a lot of them you're going to lose. So you got to choke up that stop. That's my opinion. A lot of folks that day trade say no, you got to give a long stop and trade. I'm going to stand by what I do because I have a pretty good win to loss ratio. So I can take those many short stops, and then my wins are much better. I have more wins than I have losses, and my wins are bigger than my losses. So when I'm pumping out right, I can make a percent and a half a day that I trade. I don't trade every day, and some days are blanks. So I look over the long term as to what my average could be. Can I make 20% a year or whatever? Sure. You're going to try to strive for a lot more than that. But if you want to make a living, if you want to make a good wage, you can do that on 8 or 10 pips a day. And you should be able to do that in a couple hours if you're trading the right currency pair and you understand trade entry methodology, trade entry theory. You've got a good trade entry. Because if you've got a shitty trade entry, that doesn't make any difference what you do, because you're going to be flatlined. You're not going to have a good win to loss ratio if you don't understand trade entry. So in the process of looking at making 10 pips a day, you say, geez, I'm trading a mini, that's 10 bucks. I'm trading a one full lot. Oh gee, that's I make 10 pips, it's 10 bucks a pip, I make 100 bucks. Well, that isn't going to change my lifestyle. No, boys and girls, you're right. Trading a one lot for 10 pips and 100 bucks is not going to change your lifestyle. So you're going to have to trade 5 lots. Let's make it more reasonable. A $30,000 account, you can trade 3 fulls and have plenty of runway after margin to make some mistakes. So you're 30 bucks a pip, and you do that's 300 bucks a day. Now, if you could do that a couple of days a week, that's 600 bucks a week. That's pretty good. So if you're working a job and you're making $30,000 or $60,000, and you're making $300-400 bucks a week on top of that, and that's let's say you make $1,000 bucks a month. on a $60,000 salary. I mean, that's an enormous increase in your pay. So do that. Think about that, because it's more logical to nip away at the ankles of the dog than it is to think that you're going to be the dog and wag the tail. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.